Ladies and gentlemen, good day and welcome to CardinalStone Macro Conference Call, hosted by CardinalStone Securities Limited. I trust we are all well and taking the necessary prescribed measures to stay safe in these uncertain times. As a reminder for this call, all participants will be in the listen-only mode, and there'll be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal by sending a message directly to me, the host, or by waving your hand. Please note that this conference is being recorded. We will start the call right away with the presentation from Michael Nwakalo, the macroeconomic research analyst, and Philip Anegbe, the head of research. This will be followed by an interactive question and answer session. To ask a question, kindly wave your hand and you'll be given a signal to speak when it's your turn. I now hand the conference over to Michael. Thank you, and over to you.
All right, so good afternoon once again. So today we're just basically going to look at the impacts, or basically at the preparedness of Nigeria for the impact of the COVID-19 outbreak. So is Nigeria basically back to where it was in 2016, or have we learned some lessons since then? So today, this presentation would basically just give us, some insights into how we see Nigeria's preparedness for this virus outbreak. Next slide, please. Okay, so the coronavirus, so a new strand of the coronavirus was detected in December last year, and it's now known as COVID-19. Since its detection, the outbreak of COVID-19 has affected 900,000 people worldwide, and has led to a fatality rate of about 4.9%. The good news, however, is that this fatality rate might be really somewhere around 2%, according to recent data by the National Institute of Allergy and Infectious Diseases in the US. So they basically say that when accounting for undetected cases and unreported cases, that the actual fatality rate is more like 2%. So the coronavirus so far has severed the flow of goods and services globally. It has stalled economies, and it is on course to lead to a global recession. And Nigeria is likely to be no different. Nigeria is not likely to be exempted from this outcome. So what do we know so far about the virus? We know that the virus is one that does not impact people across age groups equally. So between the ages of 0 to 50, we see a mild fatality rate of between 0.2 to 0.4%. However, from the ages of 50 to 80, this fatality rate increases exponentially from 1.3% to 14.8% for those 80 and above. Now, the good news for Nigeria is that it is at somewhat of a demographic advantage. With a median age of 18 years old, and with 91% of its population under the age of 52, the fatality rates might be a lot milder than it is elsewhere. So compared to the worst hit countries in the world, compared to Italy, with a demography of 35% of people above 55, and the US with 29% of people above the ages of 55, accounting for 18 million people and 70 million people respectively, Nigeria is in somewhat of a better position with just over 7% of its population over the age of 55. So the vulnerability in terms of age is somewhat lessened in Nigeria. Nonetheless, there are a lot of risks when you look at Nigeria and its possible approach to this crisis. So inadequate testing is one of the biggest problems that the country faces so far. Without detection of the actual number of people that have these cases, there's that likelihood that the spread could be multiplying exponentially as the days go on. Also, with the young demography, although there's an advantage, there's also a disadvantage because a vast sector of the population is unlikely to show symptoms or basically to exhibit mild symptoms. And without cognizance of having that virus, it's easier to spread. So there's that kind of benefit and cost trade-off from a young demography, basically. Next slide, please. Now, looking at global patterns around the world, if the spread of COVID-19 across Nigeria continues at the current rates, in a month's time, we're looking at over 100,000 cases from just 170 cases currently. However, Nigeria has shown somewhat better response compared to the worst hit countries that we've seen. So for example, it took Nigeria just about 30 days to implement a travel ban from the moment the first case of the virus was discovered. So this basically compares better than what happened in the US and Spain, where it took them 52 days each before they imposed a travel ban and a subsequent lockdown. So in terms of the policy response, it's been a bit quicker as the country has learned from lessons elsewhere. And strict enforcement of containment measures may also lead to a slower rate than what we see globally. And in that scenario, we predict about 30,000 cases in a month's time, as opposed to 100,000 cases. But like I mentioned before, a big risk to the containment measures are one, inadequate testing, and two, which I think is a big one, is basically the fact that the longer the lockdowns continue, the more likely that those lockdowns are going to be compromised by welfare conditions. So we basically opine that in order for this to be effective, sufficient welfare arrangements will have to be made for a vast set of the affected people. Next slide, please. So as well as first order impacts of the COVID-19 outbreak in terms of a slowdown in economic activity, there's also the second order impact in terms of its impact on the oil price. The Russia-Saudi oil price war has been made 10 times worse by the COVID-19 impact on oil demand. So demand is estimated to trail supply by as much as 20 million barrels per day. And this is more than we've seen in recent decades. It is estimated that about 5 million barrels per day of oil demand is going to be lost to air travel, and about 9 million barrels per day may be lost to the US consumer, especially given the fact that shutdowns are happening all over the country, or in states all over the country. We're also seeing a pattern in the US whereby the rate of new cases seem to be less in cities or in states that have implemented lockdowns compared to states that haven't. So in all likelihood, we expect to see more and more states that haven't already implemented lockdowns begin to do so in the coming weeks. And with that, there are adverse consequences for oil demand. We see a similar pattern happening across Europe and across Asia, and this all negatively impacts oil demand. Oil demand in April alone is estimated to fall by about 8 million barrels per day. So when you combine what's happening on the demand side with the price war and the race for market share happening on the supply side, what we have is a surplus of which we haven't seen before. Storage facilities are already at full capacity, and in the coming weeks, the oil surplus is expected to far exceed the capacity globally. So we expect the oil surplus to exceed 1.8 billion barrels in the coming weeks against a capacity of 1.6 billion or 1.6 billion. Now, as we know, not all countries that produce oil have immediate access to these oil storage facilities. So the impact on prices is likely to differ from country to country and could have even worse impacts on the, on the benchmark oil price in general. Looking at prices, prices have averaged about $20 levels in the last few weeks. And even worse is that most oil producers now, in a bid to gain more market share, are actually offering their oil at deep discounts to the international benchmark. Saudi is known to be offering its oil at $5 to $8 discounts to the benchmark. Nigeria has followed suit in order to sell, or in order to, in order to move the oil that it is producing. Now, the downside of that is that a lot of oil producers in Nigeria, especially, so for offshore producers, they basically have production costs of approximately $30 per barrel. The onshore producers have somewhat better oil costs of oil production costs of about $17 per barrel. So the more prices stay at $20 levels and the more countries offer deep discounts to the crude price benchmark, we fear that a lot of producers, especially offshore producers, would have no choice but to shut down in the coming weeks and months. And this will significantly impact the fiscal health of Nigeria. Now, typically in an oil crisis, what we normally see is oil firms reduce the cost of production significantly. And this is by reducing the cost of oil servicing, the cost of logistics, etc. But given what's happened in 2016, where a lot of oil producers were suddenly forced to optimize their costs, we're not too optimistic about the extent to which costs can be further optimized in 2020. While there can be some savings in terms of personnel costs, some logistic costs, and some services costs, we don't see costs going down as they did far back in 2016, as we believe a lot of optimization has already happened. Now the consequence for oil wells is clear. We're going to have a lot of offshore producers, especially struggle to break even and struggle to meet profitability. And as a result, we don't expect the government to achieve its 2.18 million barrels per day production target that it's set for itself. So it's pretty much grim reading in terms of the fiscal side and looking at the impacts of, at the second order impacts of the virus on oil prices and oil production. Next slide, please. So with falling oil prices and with falling oil production, Nigeria looks a lot like it did in 2016. So we asked the question, what has Nigeria learned since 2016? Are we exactly back to where we were, or are there some differences? Are there some learning points that Nigeria took? Well, we see some similarities, but we also see some differences. In terms of the similarities, we look at the FX position. Reserves depleted significantly in 2016 from about 30 billion in October 2015 to less than 20 billion by March the following year. In 2020, we see a lot of similarities. The FX reserves has basically crashed from about $42 billion in the reserves by mid-2019 to just above $35 billion now. And we expect the reserves to drop further as the first order and second order effects of the COVID-19 outbreak bite harder. We also see similarities in oil price itself. Oil prices crashed in 2015, 2016 from highs of 100 in 2014. In 2020, we're seeing a similar crash in oil prices. Oil prices currently averaging about 20 to 30, about 20 to $30 per barrel. And that is even worse than we had in 2016. Oil output, although it remains steady so far in 2020, our outlook in the coming months is a vast reduction in oil production, similar to what we had in 2016. However, we don't expect it to be as bad as it was in 2016 when we had militant activities disrupting significantly oil production activities. We also see some similarities in terms of the FX management measures by the CBN. FX restrictions in terms of wire transfers and in terms of withdrawal limits cut across both 2020 and 2016. But that's almost as far as the similarities go. We believe that Nigeria is in a somewhat better position than it was in 2016 for a number of reasons. So beginning with the FX reserves. Although reserves remain somewhat depleted from the high levels that we saw in 2019, the reserve level is still vastly superior to what it was in 2016. In terms of the pressure on the Nigerian naira, we also see reduced demand as a result of closed land and air borders. And this kind of is a preferable or a more favorable situation compared to what we had in 2016, when we had demand coming from both the speculative side as well as the legitimate production side. So that's another positive in 2020 compared with 2016. In terms of the fair value of the Naira was above 50% or was 50% overvalued at the very least in 2016. Now 2020 compares favorably, where we put the fair value of the Naira at about 437 Naira to the dollar, which basically means that the Naira is about 10 to 20% overvalued from current levels. So in the event of an FX devaluation, we do not see as harsh an impact as we saw in 2016. I think one of the areas of the most progress is in terms of banks and is in terms of the preparedness of businesses for this crisis. So looking back at 2016, we had a number of corporates with substantial FX obligations on their books: Nestle, PZ, Unilever, etc. We also had a lot of dependence on imports for inputs. And for banks, we had a lot of banks exposed with huge exposures to the oil and gas sector. And we saw very little backward integration when it came to production in Nigeria. Now, thanks to some import substitution policies in the last few years, what we've seen is improvements in a lot of those areas. For corporates, a lot of corporates have less foreign obligations than they did in 2016. The Eurobond exposures are significantly less now than they were in March 2016, when they were about $4 billion in outstanding Eurobonds. So currently we have about $3 billion. And even with that, a third of that basically consists of one company. So in terms of the number of companies that are exposed to, to FX denominated loans, it's significantly less than it was in 2016. We've also seen a lot of backward integration in the real sector on the back of some restrictions by the CBN as well as by the federal government, and as well as some incentivization measures that we've seen in this area. Now, that backward integration has basically made a lot of businesses more resilient to the global supply chain shock that we've seen as a result of this COVID-19 outbreak. So we're seeing a lot of businesses a lot more resilient than they were back in 2016. And in terms of banks, although banks are still heavily exposed to the oil and gas sector, the risk management policies put in place are far superior to that of 2016. So we see a lot of banks giving out loans at lower oil price benchmarks than they did in 2016. And very importantly for the banks is the CBN's recent directive on forbearance. What it means for banks is that they are now able to restructure loans in terms of prepayment plans and in terms of the tenor of the loans to basically accommodate for the impact of the coronavirus spread on both businesses and individuals. So as a result, we see some asset quality improvements and we see less of an asset quality drag for banks compared to what we saw in 2016. So all in all, while we see a lot of similarities between 2016 and now, we see a lot of resilience, both for the banks and for businesses in general. Next slide, please. Now, as I mentioned in the last slide, the CBN has put in place some management or some restrictive measures on FX. And we asked the question, is the CBN right in putting in place these measures? Obviously, there's the point of view of, the more scarce FX is, then the more we expect speculative activities to run, and we expect the gap between the parallel markets and the official markets to widen. But looking at this distribution of FX supply by the central bank, what we can see is that a lot of FX supply is earmarked for the industrial sector, the manufacturing sector, for the industrial and for the manufacturing sector in general. The oil sector used to be a big part, or oil imports used to be a big part of FX supply, but as you can see, over the years, this has reduced significantly. And in 2020, we're at a situation where, we're at a situation where there are no more subsidies for oil imports, and the demand from that angle has reduced substantially. So given that the industrial goods sector and the manufacturing goods sector are likely to be affected materially by the lockdown across central cities across the country and by the reduction of economic activity, is the CBN right to reduce its supply of FX, given that the actors in the FX markets are likely to be, or in the FX, BDC and black markets are likely to be speculators, as the people who demand FX for travel and for business are basically all but non-existent with the air travel restrictions and the border restrictions in terms of land that we're seeing. We also see lower demand for FX in terms of, given the backward integration that I mentioned earlier, as well as lower capex, as well as lower capex spent by the federal government due to its, or as a measure to reduce its spending, given the lower oil prices that we're currently seeing. So once again, we ask the question, is the CBN, too harsh, or is it right in reducing its supply of FX? At this point, I would just like to ask my I would like to ask my colleague Philip to basically interject or to basically add one or two things that he has to say on this slide.
Yeah, thank you very much, Michael. I think you really hammered on the key areas of the presentation already. However, I would want to note that for a long time coming, Nigeria have had issues on the balance of payment fronts. More recently, we saw pressures on the goods balance, I mean the trade balance essentially, where we had moderating exports and increases in imports. So whilst for the export leg, there is very little you can do given our exposure to volatility in crude oil prices, we do think that there could be some savings on the import side of things. And I'll take you to the last 2 quarters of reported data for trade balance. You see that the increases in imports was largely tied to one-off importation of some capital goods. And those importations were closely linked to the Dangote petrochemical plant construction of project, as well as some rail construction. So if indeed those importations are deemed non-recurring, largely non-recurring, you could see some moderation on import growth, and that could have some bearing to what happens to the trade balance going forward. However, we do note that given developments on the other sections of balance of payments, you may still see a need, or there may still be a need to actually reprice the currencies or more, maybe closer to its fair value of 437 naira to the dollar. But the message here is clear. Legitimate demand for dollar appears to be significantly impacted by recent developments. Add to that the fact that we've had a number of one-off or non-recurring importation of capital goods. You will find that there may be some slight offsetting impact on these fronts, or some sort of import savings this period. So more or less, it provides some justification, just maybe a little justification to CBN's recent restriction or explanation that dollar demand is moderating, legitimate dollar demand, I mean, is moderating, and there's maybe perhaps no need to fan the flames and encourage speculative demand. So that's the view of this slide. So over to Michael. Michael.
All right, so next slide, please. So I think on this slide, what we're seeing is pretty much similar to what we saw before. So we're looking at the CBN's allocation to what we call, or to what they call, invisible imports. So as you can see, the allocation to the financial part of these imports has increased materially from 2016 to now. Now, when you take into account that a lot of the supply of this FX is dependent on international business, in terms of profit repatriation, dividend repatriation, PTA, BTA, transport and tourism allocations, etc. So when you consider that a lot of that FX supply is tied to international business and travel, and at the same time, we're seeing a global slowdown as a result of this COVID-19 outbreak. What we're seeing is that in terms of invisible imports, similar to the visible imports, we're seeing substantially reduced demand compared to what we used to see or we expect to see substantially reduced demand compared to what was the case in 2016. And as a result, we expect to see less pressure on the currency. But like we said, we still expect further repricing of the currency closer to its fair value of 437, as the pressure that remains may still be substantial enough to lead to this devaluation. Looking at the CBN's intervention in the last 2 months, they've intervened in the INE window by over $2 billion in both March and in February. Now this compares, or now this is in stark contrast compared to the intervention that happened in the middle of last year, which was barely any intervention in the first 4 months of 2019. And towards the end of 2019, we also saw some intervention, but nowhere near the levels that we're seeing now. So that shows that there is legitimate pressure by FPIs to repatriate funds. But the message here, once again, is that the amount of legitimate demand is reduced significantly as a result of the slowdown in global business and in global travel. Philip, would you like to add something before I move on?
Yeah, thank you very much, Michael. I think it's important once again to take you all to the balance of payment analysis or development. We've seen that for some quarters coming, we've been having pressures on the services end. And the pressures were closely linked to travel-related expenses. You have some other services-related spend on businesses, education, health, tourism, and the likes. So it appears that the CBN is putting forward a strategy to actually curb pressures on the services end. And it may also align with the recent suspension of FX activities at the BDC levels and also some other restrictions put in place. Michael has homed in on the reality that we are likely going to see, or we are seeing already, moderating global activities, both from the visible end and the invisible side of things. So that could materially impact allocation of FX going forward, or the need to actually allocate FX going forward. So again, we think there could be considerable savings on these fronts, but it does not in any way rule out the pressures we are likely also going to see from the export side of things. I think we've made that very clear that it could, as a matter of fact, lead to further repricing of the currency closer to its fair value. So over to you, Michael. I think that's...
All right, thank you. Next slide, please. So we've talked about lower oil prices and potentially lower oil production, given that the prices just don't really, just cannot translate to profitability for a number of producers in Nigeria. And all those have clear fiscal implications on spending and on revenue for the government. Now, it's clear that, with significantly less revenue expectations, our spending is going to be reduced significantly. The ability of the federal government to stimulate demand through spending would also reduce significantly. But we choose to look at the nature of Nigeria's response. Is it adequate, and how does it compare to what it's been doing in the past? So I think one thing that we look at favorably is the fact that Nigeria's response has been quick. So Nigeria's first COVID-19 case was announced in late February, and within 2 weeks of its announcement, the Ministry of Finance announced revisions to the budget, both on the revenue and on the expenditure side. The budget benchmark was revised from $57 per barrel to $30 per barrel. Oil production was, however, left at 2.18 million barrels per day, which we do not think might be as feasible. In terms of revenue, revenue forecast was cut considerably by 45%. Expenditure was cut by 1.5 trillion naira. And this is as a result of a 25% cut in current and a 20% cut in capital spending. Other cuts made by the federal government include a ban on further recruitment of staff, as well as federally funded projects. Now, a number of federal government measures have been put in place to mitigate the impact of the COVID-19 outbreak. One of them, or a number of them, are basically on the slide below. So we know that the federal government released about 15 billion naira for the tackling of the effects of the COVID-19 outbreak in Lagos. It also directed a 3-month repayment moratorium on a number of federal government funded loans. And on the welfare part, on the welfare side, we've seen immediate disbursements of 2 months worth of conditional cash transfers, as well as welfare packages to the most vulnerable and in the most vulnerable areas of the COVID-19 outbreak. And I think very importantly as well, we've seen a reduction in the PMS price from 145 to 123.5 naira. We estimate that that would have an annual consumption support of over 300 billion naira. So we've seen pretty robust responses here by the federal government. And I think also recently, the federal government postponed the hike in electricity tariffs, which was meant to take effect in April for a number of months. And that postponement as well is likely to mitigate the reduction in disposable income that we see in the near months as a result of the unemployment impact that could come as a result of the outbreak of the COVID-19 crisis. Next slide, please. So we've looked at a number of measures by the federal government, but what we've been particularly impressed by is the handshake or the alignment between the federal government, which is the fiscal side, the monetary authorities, as well as the private sector. So what we saw was, even before the federal government ordered a lockdown in vulnerable cities, the private sector had already begun to execute shutdowns, in various offices around the country. A lot of precautions were being taken to mitigate the spread of the virus. We've also seen direct financial support from the private sector like we've never seen before. A number of banks have pitched in with substantial contributions, both in terms of providing physical infrastructure and also in terms of providing funds to help the federal government combat the fallout of this COVID-19 outbreak. So what we're seeing is, is an alignment like we've never seen before, and that is definitely positive. Now, while Nigeria's response pales in comparison to what we've seen in the West, we basically look at how its response compares with other oil producers. On the fiscal and monetary side, we believe that Nigeria's response stacks up well so far. Beginning with the fiscal side, we've seen Nigeria reduce its spending by about 1% of GDP. This is similar to what we've seen across other oil-producing countries as their major source of income is being depleted. However, we do note that a number of oil-producing countries have been able to cut their budgets by a substantially larger amount. And we think that that is majorly because the composition of Nigeria's federal government spending is heavy on recurrent and is heavy on the debt servicing side. So those types of expenditure are more difficult to cut than in other countries. We've also seen waivers given to some select industries to enable them or to help them mitigate the impacts of this crisis. The healthcare industry is one. So we see such concessions happening in various countries, in various countries as well. And I think the main difference that we note here is that in other oil-producing countries, their concessions are trying to put more money in the pockets of consumers and of corporates. So we're seeing reduction in corporate taxes, exemptions being granted in corporate taxes as well as in personal income taxes. As we all know, because of Nigeria's peculiar situation of a revenue generation problem, it has sought to address, disposable income issues in different ways, such as welfare packages, as well as, conditional cash transfers. So we believe that Nigeria's response so far on the fiscal side stacks up well to other oil producers. Looking at the monetary side of things, what you can see is that most oil producers have tended to cut rates. Now, given CBN's position of having reduced rates in the last few months through ad hoc and through administrative measures, it has had less of a need to do so, especially more so because the monetary policy rate is more of a signaling tool than actually something that transmits through the economy. So we've seen the Central Bank of Nigeria focus more on direct interventions into the real sector. For one, it extended the moratorium of its intervention facilities, and it also reduced CBN intervention rates or CBN intervention loan rates from 9% to 5%. It has also contributed, I think, materially with a significant injection of cash of about 3.6 trillion naira to support the healthcare, the manufacturing sector, and the agriculture sector. So we expect this flush liquidity to at some point trickle into demand and to help mitigate the crisis. Now, given Nigeria's significantly weaker reserve per capita, we believe that it's basically stacks up well when compared with other, when compared with the response of other oil producers. Next slide, please. Okay, so in this last slide, we're basically looking at the impact of, on the potential impact of various sectors of the economy as a result of this COVID-19 outbreak. We know globally, most of these industries are facing downturns because of this external shock that is unforeseen, and Nigeria really is no different. So looking at the financial services to begin with, even before the crisis, we saw stiffer, we saw stiffer regulation in terms of its non-interest income, of fees and commission income. And we expect that to still weigh on the performance of that sector. We expect slower economic activity to also weigh on banks' ability to grow loans and as a result to record interest income in this period. However, we do note that a lot of banks are a lot more resilient to this crisis compared to before because of risk, because of improved risk management policies that they have in place, as well as improved FX positions compared with the last time. So banks like Zenith and GTB are in very good positions in terms of their foreign currency holding, and as a result may record FX revaluation gains, which would help them weather the shocks in that sector. For the consumer goods sector and the construction sector, we see significant slowdowns in both of those sectors as a result of reduced activity, change in human behavior. For construction, capital projects have been or will be affected materially, owing to the 25% reduction of capex by the federal government, as well as the lockdown that we're seeing in major financial hubs of the country. The oil and gas sector is pretty clear what's going to happen there with the twin effects of both lower prices and lower production. That sector is likely to contract compared to what it was doing before. We do know that firms in that sector, however, are once again more resilient than they were before. Surplus, for example, has hedged a significant amount of its production at a price above the current prices. So that helps it weather the storm a little bit. So we also expect a downturn in the logistics industry as non-essential businesses are shut down across the country. The sector that we see upsides for is ICT, and I think the reason is pretty obvious, right? With most of us working from home, working more remotely, with global travel grinding to a halt and more people having to communicate from a distance, we believe that these, that providers within this sector stand to benefit massively from that. And we see MTN, Airtel Africa, Glo as potential beneficiaries of that. For the healthcare sector, we're neutral on that sector. We believe that the increased usage of medical supplies and drugs would provide a boost to that industry. But we are cognizant of the fact that a lot of that industry still depends on imports. So we're kind of mixed on the healthcare front. So I think before I conclude, I just basically want to, address, some lessons that Nigeria might learn going forward. So Nigeria might see this as an opportunity to double down on some of the things it's been doing since 2016 that seem to be working. Some import substitution policies, trying to encourage more local supply chains and reduce dependence on international supply chains as much as possible. We also see this as a strategic opportunity that the federal government could use to deregulate the downstream sector, to basically drive more investments into that sector, and to have it more self-sustaining. We see improved investments in previously neglected sectors like the healthcare sector, the education sector, the ICT sector. The healthcare sector for obvious reasons, and the ICT sector, I think this crisis has basically underpinned or highlighted the importance of having strong ICT infrastructures, as more workflow in the coming years is likely to emanate or is likely to be executed remotely. So we see a number of long-term changes coming about as a result of this crisis. But I think in conclusion, we see a lot of similarities between now and 2016, but we see Nigeria as a lot more resilient than it was before. Philip, would you like to add something before we close?
Yeah, just a few points. One is that opinions are still divergent on the sufficiency of the measures adopted both by the fiscal and monetary side of things. But where there is agreement or consensus is that the authorities are moving in the right direction. And for the first time in a very long time, we are seeing very good cooperation from the private sector. And all of these are likely going to be further bolstered by supports from institutions outside the country. AFDB, they are more or less on the $3 billion social dollar bond issuance that was oversubscribed, and it's meant to actually support African countries in the fight against COVID-19. You see Europe getting about 37% of that subscription, another 36% to America. So all of that likely to support. But more importantly is the recent move by finance ministers across African countries to get some sort of debt relief to the tune of maybe $100 billion for African countries. And they are looking to get the buy-in of IMF, World Bank, and the European Union. If that pans out, that can also be very supportive for Nigeria, given that we have external debt as about $27.6 billion, given the 2019 numbers. And I think debt service, both principal and interest, was about $1.3 billion in 2019. Of that lot, I think just a little below $1 billion was on interest service. So if they succeed in getting some sort of forbearance on interest payments at the very least, say for 2 to 3 years periods, which is what they are really pushing for, we may likely see some sort of reprieve, some sort of release, or some sort of fiscal space to be created for to help combat the spread of COVID-19 and maybe flatten the curve on time. So we do see these support factors going forward, and we feel that the government is moving in the right direction, and developments across Africa and around the world are likely going to provide support as the months go by. Thank you.
All right, thank you, Philip. So I think that's a wrap.
Thank you, Michael. We will now begin the question and answer session. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. Please note that you can ask the questions by typing it out in the Q&A session, or you can indicate by raising your hand. The first question is from Afolabi Lawal. Please, you may go ahead. Hello, Afolabi Lawal, you can speak.
My question is, can you hear me now?
Yes, we can.
Oh, thank you very much. Okay, my question is, if you can speak to the impact of COVID-19 on other institutional groups within the financial services. By other institutional groups, I refer to insurance companies, asset managers, and the pension fund administrators. I will appreciate that. Thank you.
Okay, for pension fund administrators, you want to think that they are likely going to be exposed to the extent to which the recent developments affect markets generally. Equities exposures are likely going to take some beating, and we've seen equities market moderate. It's likely going to cascade to pressures on that front for them. We've seen the yield moderation in the domestic space also likely going to have some impact. So overall, we think that activities are likely going to slow in the time being for the PFAs. Then for the insurance space, activity is also likely to be slow in terms of maybe setting up or opening up new accounts because of restriction activities and movement. So you may see more or less little account opening activities across board. But there are indications that you may get some benefits for a few of them. Those that are able, or maybe proactively set up a remote operating system. So those ones are more likely to better weather the storm. But overall, we expect activities to be a bit hit across the financial services space and the non-bank institutions.
Yeah, so I think just to add to that, for insurance, on the one hand, while the insurance sector is likely to receive less claims from especially the ones focused on accidents and and things like that, while they're likely to receive less claims, we see the bigger impact being on reduced premiums, on basically lower premium payments, lower acquisition of customers. So we think the insurance space is going to be hit, as in terms of new flow of funds, they wouldn't get as much as they've been getting previously. And I think it's kind of similar as well for pension funds. You know, employers are going to have less cash at hand. And what that would mean is lower payments in terms of, is lower payments in terms of pensions and etc., or basically lower pension payments in terms of the value of those payments. And that could also, I guess, impact on the amount, on the amount of new funds that these businesses in these industries get. And that could basically last for a while, depending on the nature of the spread of this virus.
Thank you, Michael. The next question is from Yusufu Ishako from Wellfield Partners Limited. So his question is, a couple of days ago, UK lenders agreed to scrap cash bonuses in order to help in cushioning the impact of economic recession. And this position is supported by the PRA. In the likes, we learned that Britain's largest bank have agreed to scrap the Great Britain 8 billion worth of dividend. So his question is, do you see the above steps happening in Nigeria in particular and Africa in general? And he would like to know your thoughts on views on this with focus to the 2020 dividend payouts.
You don't want to rule this out completely. Already you're seeing very strong private sector buying, strong private sector commitments in helping to resolve the issues. But then you also want to wait to see how events play out. But so far we are seeing private sector more or less helping to curb the situation. However, it's important to note that across the sectors, Michael pointed out that you expect weaknesses, earnings weaknesses across a number of sectors. So that may, by default, affect their dividend payout for next year. So you expect it to at least be very low. But then private sector may also look to actually go the extra mile to providing support or maybe adjusting expectations on the dividend fund as well.
Okay, thank you, Philip. So the next question is from Samson Isemuide from Cross Investment Management Limited. Please, you can go ahead and ask the question.
Hello.
Hello, we can hear you.
You can hear me. Thank you very much for the presentation. It's quite informative. I have 3 questions. The first one is your views around the social implications on the strategies that are required to curb this COVID-19 spread, given the poor sanitation, people living in crowded buildings, people living day to day. Ultimately, when you have situations where you start to lock down city, that starts to tell. And the nature of our society is such that the social cohesion is not very strong. And as such, you might start to see some sort of agitation, which could lead to some sort of an unrest. So in your view, what is the probability that that is a situation that could crystallize? So that's the first question. The second question I have is around the fiscal pressures that you alluded to. And you did say that there's been some initiatives which has been taken, but when I look at the actual numbers rather than the budgets, right, the revenue for 2019 was about 4 trillion, of which about just over half of that was from oil and gas, which is down 60%, if not more, if you adjust for production cuts and discounts. So you're looking at full year revenue, if we kind of stay where we are, at around 3 trillion or over, assuming everything else stays. So from that perspective, I think that the fiscal pressure perhaps is a lot larger than you were alluding to. And that also means that you might see pressure both from the federal government and the state governor to force the central bank to move the exchange rates much bigger than your fair value in order to increase Naira liquidity to solve the fiscal strain? So that's the second question. I would like to hear your views around that. And then the final question is on your FX reserve, which you pointed that is much larger than the position where we were in 2016. But in that reserve includes a big swap component and also a large but probably shrinking FPI component. So it'd be quite nice to break that down. And then in your view, at what point do you think the central bank would have to give in rather than continue to deplete the reserves, even though I understand the import demand is a lot less than it would have been, let's say, 3 months ago?
Now, in terms of impact on the social framework, I think Michael did well to point out that there's a key risk on this front, particularly because, quote and unquote, that a number of Nigerians basically live from hand to mouth. Basically, they end their living every day. So that is a key risk, and the government, I think, is also realizing this with a number of initiatives that they're trying to put forward to help more or less alleviate these concerns. There was a decision to release about 70,000 bags of grains from the strategic reserves to distribute to the poor, the very poor people in the country. And also there is the conditional cash transfers amongst a number of other initiatives. And I think the Lagos State government has also embarked on a few. And if you look at the restrictions imposed, you will see that there is some sort of a subtle allowance for the distribution or maybe sales markets of people who actually distribute or sell foods at the retail and at the retail level. So there's some sort of a allowance granted on that front, all of those to actually alleviate the concerns and fears that it could maybe cascade to insecurity, like you noted. But those concerns are real, and we agree with you. On the fiscal side of things, we do think that there is a very strong chance that the deficit could be wider, right? Especially given the issues we are seeing on the oil price front. So deficit could be wider, there's a chance. And we've noted that there could be need to adjust the currency some more closer to its fair value of 437. However, the 437 was arrived at using our inflation expectations for 2020. But the reality may be, or just may be, that with the current crisis, panic buying and shortages across a number of cities, you may see inflation actually go beyond our expectation. In that case, the fair value will have to be a lot more than the 437 level. In that case, yes, just maybe there will be further adjustments to reflect those fundamental changes. So those can happen. Please, can you take the last question? Can you mind taking that last question, please?
No, I'm sorry. The last question was around the reserves that you mentioned, because I mean, I think Philip made some statement around the balance of payment pressure receding on the back of one-off import components and also services being under pressure as a result of a global slowdown. But the FX reserve itself, the composition, the breakdown of the FX reserve, I mean, the last time I checked, there was a significant swap component which was there. What is the likelihood that this is going to be unwound, given that there is a massive dollar, well, not massive, but there is a growing dollar squeeze at the moment? And then there's also the FPI, which is declining depending on who you listen to. But I mean, if we have a sense of what the stock is, it would be quite interesting to know how big the pressure on both from the foreign investor perspective and from the banking sector on the back of the swaps is going to be on the reserves. And by extension, at what point do you think that the central bank would have to effectively adjust the currency to stop the decline in reserves on the back of these pressures?
Okay, thank you very much. I think for swap position, I would say some $7 to $8 billion. And as of December 2019, I think FPI component was about IPI into OMO component is about $14 billion. And let's safe to say that there's been some sell-off. So maybe somewhere close to $12 billion. You adjust for both, you see that, of course, the reserve is not as good as the gross value suggests. These are real concerns, obviously. But we think that the CBN is actually holding on to the thoughts or expectations of probably, in actual fact, maybe the reality that demand for dollar is way lower than a lot of us may think because of the current crisis. There's practically nothing happening on the dollar demand side. When I say dollar demand, I mean legitimate dollar demand side. I don't see people getting BTAs, PTAs for travels, knowing that this is strongly linked to what happens to the BDCs at the BDC's end. I think north of 30% of CBN's dollar intervention. So probably the CBN is banking on that to more or less offer some sort of reprieve on that front. In any case, we are thinking that if the pressures we are seeing on the exports side of things largely are driven by the moderation in crude oil prices, if that continues, we are thinking that we may see another repricing of the currency within the next 2 quarters. Within the next 2 quarters, the CBN may move again to reprice the currency closer to its fair value. And depending on what happens to inflation differential, it just may be higher than the 437 level with time, right? But we always favor, I always prefer to say that the CBN is more likely to stagger the devaluation, whatever devaluation adjustments, currency adjustments they do. I prefer to say they will stagger it, given the political sensitive nature of the devaluation discourse in Nigeria and the impact on the broad economy. We're seeing a small devaluation in the last few weeks. We may see some more as the weeks go by.
So just one more question for me, if you don't mind. So in terms of thinking about this impact on asset prices, right? So I'm trying to figure out, because what you've alluded to is a sort of CBN balance sheet expansion, which is happening at the same time where you are sort of having pressures on the exchange rate. So what is your outlook on the OMO rates at the moment? Do you think that we go up from where we are, the 14th levels, to where is the direction? I know the direction of travel, but what do you think the magnitude of that move will be? And given also the wider than expected deficit financing that needs to happen. I know at the moment there's excess local liquidity, but at some point that liquidity starts to get dried up. So what is your view on NTB and the impact that has, that could potentially have on that as well?
Okay, I'll talk on the OMO rates first. I think I prefer to look at what happens on that front by reviewing the carry trade in Nigeria relative to comparable markets like Egypt. Egypt has a better carry trade opportunity. I think Nigeria's carry trade at the current level, we are still seeing some sell-offs from FPI. So maybe that carry trade will have to be a bit wider to compensate for the extra risk that we are seeing. And we believe that the CBN would may do what it can to actually expand that carry trade just to incentivize FPIs to roll over on OMO. So that's the view there. So that may necessitate some sort of upward repricing of OMO rates, essentially. Hello?
Sorry. And NTB, do you have a view there, or do you think the local liquidity situation will keep yields low?
Okay, I think on domestic fixed income rates, you expect the measures taken by the CBN, the administrative measures to continue to keep rates low in the domestic market, at least in the near term. This is more so given that you are getting a lot of buying, a lot of facilities flying here and there, all of them are looking to come into the market at substantially low rates, just to provide some sort of stimulation. I think over the broad expectation is that they will, the authorities, the monetary authorities will try do what all in its power to make sure that yield is low enough to support our borrowings across board, and that may largely impact what happens to yield in the fixed income space for domestic fixed income instruments.
Okay, thank you.
So, and just to add to that, so we know that the T-bill market has been largely illiquid in recent months. So it's less responsive to the normal macro developments, and it's just simply a demand and supply determinants that basically determines if rates go up or rates don't. The supply of T-bills is still pretty scarce, and we expect that there will be a lot of demand relative to supply in that space for in the near future, and with the central bank still issuing out or still having auctions, where the 364-day bill is around 4% rates, we don't expect much change in the T-bill markets in the near future.
Okay, understood. Thank you.
Okay, thank you. The next question is from Ibikunle Olatunji from African Alliance Trans PLC. So his question is, what is your view on the interest rate environment for the next 3 to 6 months, as well as impact of all these on borrowings by the federal government?
I think the question on interest rate has been answered. Then view on fiscal borrowings is that we may see a lot more fiscal borrowing in the coming quarters. And that speaks to the expectation that deficit may be wider than initially expected, given the expected moderation in oil earnings. And even non-oil earnings may be impacted because of the slowing macro activities in Nigeria. So companies will pay less in taxes, both CIT and VAT may be lower. So deficit may be wider, and that may actually force the government to borrow more. And given a tightening external financing condition, you may see they may do a lot more domestic borrowing. Borrowing externally now would be quite expensive. Thankfully, CBN's unorthodox measures, unorthodox is good because it is kind of saving us now when you do it from the other side. Those measures have helped to keep domestic rates at decent levels for the government, from the perspective of the government. So they will need to do a lot more domestic borrowing to actually plug the deficits. Thank you.
Thank you, Philip. So the next question is from Dimeji Sonowo from SFS Capital. So his question is, what is your forecast on ability to service the Eurobonds?
Okay, so I think on the ability to service the Eurobonds, Nigeria's FX reserves are still robust enough to service these bonds. And I think the credit rating impact or the credit impact on a default is too large for Nigeria to contemplate not servicing these bonds on time. So I do not see an issue in terms of Nigeria's ability and also its willingness to service, or to service its Eurobonds in the near term.
Okay, to add to that, you look at 2019 numbers from the DMO, you find out that debt service on external borrowings was about $1.3 billion. Of that lot, I think commercial borrowings, Eurobond and diaspora bond accounted for over 50%, right? So the expectation could be that just maybe if the ministers across the African countries are able to get some sort of forbearance on interest payments on maybe World Bank, AFDB, and other bilateral loans, there may be just enough left to service Eurobonds and other commercial borrowings, basically. So that's the thought. So that could provide some support in relation to the point Michael made.
Okay, thank you. The next question is from Adeisa Afolabi from Trust Fund Pension PLC. So his question is, where do you think the fair value of the Naira should be, and when is the country likely to go into recession?
Well, we mentioned that by our computation, the last time we checked using inflation differentials, we said 437 to the dollar in terms of the fair value. However, scarcity-induced pressures on inflation, widening fiscal deficit, current account concern could actually force the fair value to go higher. So there's a chance, right? And in terms of growth, we expect that there could be a contraction in economic activities as early as Q2, and if the conditions deteriorate further, you may see it for Q3. So a recession is very likely this year. However, it is feared that the global economy is even going into a recession. So it's not a Nigeria-centric concern. It's a broad concern. I think we should concern ourselves more about the measures we are taking to actually get out of this hurdle as quickly as possible. The ministers, finance ministers across Africa, they are projecting that the slowdown in Africa may actually last between 2 to 3 years. That's to tell you how unprecedented the level of pressure is. However, there are some measures that are being taken to help, more or less, help the economies, including Nigeria, recover from the shock. And we are thinking that compared to some African countries, Nigeria is actually putting a strong foot in, and those efforts can be complemented by what happens from or what we gain from the international organizations like AFDB and the World Bank. So we're expecting some sort of restructuring of existing facilities, which is what the ministers are pushing for. We're expecting more private participations. We've seen banks donate huge sums and even embark on the development of fiscal health infrastructure to support the fight against COVID-19. So if all of that continue to come, we expect that we just may be able to flatten the COVID-19 curve relatively early in our view.
Okay, thank you, Philip. The next question is from Andy Chang. What kinds of business activities are affected by the lockdown order, and how long is the lockdown for Lagos? How good is the compliance with the lockdown order? Are people still going out and about? Is there a significant drop in traffic on the streets?
Okay, so in terms of what kinds of businesses are affected, I think all businesses basically are affected by the lockdown, all non-essential businesses. So although grocery stores, pharmacies, and healthcare centers are likely to thrive in this environment, as well as ICT companies, for the majority of industries and companies, I think they are just as affected as anywhere else in the world. Globally, we've seen downturns in so many industries: tourism, aviation, hospitality, etc. Nigeria is no different. How long is the lockdown for Lagos? The lockdown so far is for 2 weeks, but our base case expectation is that the number of cases are going to rise exponentially within that time, and that lockdown is likely to be extended and even extended to, to partner cities, to border cities as well. The compliance so far is pretty good. I think you're not seeing the same traffic of people on the roads. The roads are a lot freer than they were before the lockdown. Obviously, some parts of Lagos are likely to be more compliant than some other parts of Lagos. I think like Philip mentioned before, a big sect of the population still live from hand to mouth. So I think in areas where where lower income people are clustered, we're likely to see less of a compliance in those areas than in the more, than in the more affluent areas of the city. So far, we've seen a little unrest based on welfare concerns, but I think in the whole, the compliance has been pretty good, and there's a significant drop in traffic.
Okay, thank you, Michael. So the next question is from John Neopold. It looks like Nigeria is doing better than 2016 in terms of FX, but do you think that this will restrict repatriation flows? At the moment, it seems like they are.
So definitely, I think it's going to mitigate repatriation flows a lot more so than was the case in 2016. And I think also when we look at 2016, Nigeria was part of the JP Morgan index. And once we were taken out of that index, a lot of index-based funds immediately withdrew their funds from the country. Since our removal from that index, we're seeing a lot less index-based investments and more strategic investments. So strategic investments are less likely to repatriate as quickly as the index-based investments. So on that front, we might see less repatriation flows than we did in 2016. Also, I think, as I mentioned earlier in the presentation, a lot more businesses are more resilient. So especially for the FPIs who invested in these businesses, they are less likely to just look at the crisis and leave immediately without looking at, at the resilience of their companies and the potential profit that they can make if they stay the course. Yeah, so I think in terms of repatriation, it's likely to be less based on some fundamental shifts from where we were in 2016.
Okay, thank you, Michael. The next question is from Sahil Kumar. Please, you can go ahead and ask your question.
Robert?
Yes, please.
Yeah, just before the question, I just want to add something. Right now, there's some restriction on CBN dollar sales, especially given the 2 weeks that was imposed for BDCs, and of course there are some other restrictions. I think that's where that last question was coming from. But after this period, after this phase, this initial phase, which is mainly geared at providing some sort of leg room to better confront or combat the virus, you may see them return to sales. So it could also support dollar repatriation or repatriation, like the last caller mentioned.
Okay, thank you, Philip. Okay. Sahil Kumar, you can ask the question now. Hello, Sahil, you can ask the question.
Hello. Thanks to you.
Hello.
Hello, can you hear me?
Yes, I can hear you now.
Yeah, I'm asking what is your fair value of Naira? I misheard, is 437 or 457?
Okay.
And also, I'm also working with MJ. I'm also working with MJ.
Michael, do you want to take the question?
So if I understand, the question is the fair value 437 or 457? Is that correct?
Yes, it's 437 or 457.
Okay, yes. So we said 437, and that's based on interest rate differentials between Nigeria and the US.
Okay, yeah, that's all. Thank you.
Yeah.
Okay, thank you. The next question is from Dimeji Sonowo. Do you see immediate possibility subnationals struggling with servicing loans as a result of drop in FAC?
That is a strong possibility that there will be some drop in FAC, and that could affect subnationals. But in terms of the loans, we would not be surprised to see a lot of restructuring. I've alluded to restructuring of the across Africa, restructuring drive across Africa. You may see a lot of debt restructuring across the continent, and even for individuals, right? So that may happen. But it's also important to note that the adjustment in the exchange rate at the official market will provide some offsetting impact on these fronts. But by and large, you expect that FAC may be slightly, maybe lower than it was before, and could provide, it could lead to some concerns on debt services fronts for the states. However, there is a strong chance that a number of those debts will be restructured. There's already a move in that direction in the continent.
Okay, thank you, Philip. The next question is from Nnamdi Nwuzu. What do you think happens to Nigeria's debt profile and foreign reserves if the oil price hovers around $24 per barrel for the rest of the year?
Well, if that happens, I think it's just saying, basically that person is just saying, if oil earnings remain low for the rest of the year, what will happen to debt service? Of course, it's going to be concerning, right? And I think the ministers across Africa, as I've already alluded to, they were very proactive in calling for a meeting, trying to get World Bank buying, trying to get the European Union buying, trying to get EFTDs buying, to restructure a number of existing facilities. And I think that is the right way to go. And that is because they also realize that if the pressures continue, especially for oil producers, if the pressures continue, they may find it very hard to cope with debt service obligations, or even they may find it very hard. I did mention that external debt service for Nigeria was about $1.3 billion in 2019. Interest fees on that is just a little below $1 billion, right? So if you can get any kind of reprieve by moving to restructure these facilities, is going to be very positive, given that crude prices are lower and what you expect in terms of overall dollar receipts is also likely going to be lower. So I think some proactive response across the continent, and that should also help to slightly taper the impact. But overall, we are thinking that unless that happens, we may see some more pressure on debt service. So debt service burden could be bigger if the initiatives don't materialize as expected.
All right, so just to add a little to that, in terms of debt service, given the recent cuts by the federal government on its budget, we estimate debt service to rise from about 30% to more like 56.7% in 2020, if all prices, well, regardless of all prices really, just based on revenue cuts and the expenditure cuts as well. And, you know, back to Philip's point on debt relief and Nigeria's proactive measures to get as much debt relief as possible, I think the good news on that front is that one of our major creditors is the World Bank. And the World Bank recently came out to basically push for debt relief across, across developing markets. So that is, I think, good news on debt servicing front. Otherwise, I think it would be really difficult for Nigeria to shoulder that debt service burden of over half of its expected revenue. So I think in summary, Nigeria is a little bit lucky that its biggest creditors are multilaterals who are more than willing to give the debt relief that it seeks.
Okay, just to add some figures to Michael's point, you look at our external debt stock for 2019 of the lots. World Bank, outstanding World Bank debt is $10.1 billion. Outstanding AFDB debt is about $2.6 billion. Then you have bilateral institutions across countries contributing on that $3.8 billion. The rest, of course, are commercial facilities. So we are thinking that concessions or some sort of restructuring can happen at on the outstanding balances for the World Bank, AFDB, and maybe some of these bilateral institutions could move to also provide some sort of support for countries that are struggling, particularly countries in frontier and developing markets, essentially.
Thank you, Philip. The next question is from Olasiji Omotayo. What is the average cost of crude oil in Nigeria? And at what level do you think Nigeria may stop production?
Well, average cost of crude oil in Nigeria from sources gathered in terms of some sort of a weighted average cost should play around, say, between $23 to $25 per barrel. However, at the deep offshore end, I think the production cost is put at slightly above $30 per barrel, while for onshore production, that maybe onshore production, you have it at around, I think at between $15 to $17 per barrel. So those are the numbers, right? So you would want to think that if oil continues to trade at below $30 per barrel, a number of offshore, deep offshore producers may be put off, may turn the taps, put the taps off, and they contribute about 40% to our oil production. So that's also concerning. But the balance 60% producers, they have a relatively lower cost. I've said cost ranging between $15 to $17 per barrel. There's even a producer that you know very well, Seplat, that has really very low cost of production. They have most of their facilities onshore as well. So if prices remain at this level, you can have it that the deep offshore producers may turn the tap off, but you still have about 60% of that market still producing because their cost is still lower. Thank you.
Okay, thank you, Philip. The next question is from Bola Ibrahim. Despite the initial policy response by the fiscal and monetary authorities, will the macroeconomic adjustments be enough to contain external shocks? Noting that last Friday, S&P lowered Nigeria's ratings to B-, citing that the administration's policy response are unlikely to be enough to mitigate the decline in oil revenue, and foreign exchange reserves levels are likely to come under pressure.
Yeah, thank you for the question. And I think we've made it very clear that despite the adjustments or the responses we are seeing from the fiscal side, the monetary side, and private institutions, there may still be a need to adjust the currency some more. And that is because we realize that we are still very vulnerable. So on the balance of payment and fiscal fronts, we are still very vulnerable to the twin impacts of COVID-19 crisis and falling oil prices. So that adjustment may be necessary. So we are still very vulnerable on that front. However, we think that attention should shift to the things or the measures we are putting in place to help us recover from this global crisis. It's important to mention global on this front. It's not a Nigeria problem, it's a global problem. I've told you that the ministers across Africa, they're estimating that this crisis could cause a growth slowdown that will last for between 2 to 3 years. So, but the more proactive countries, those who take better measures, may recover quickly, maybe ahead of the others. So We are thinking Nigeria, with the support we are seeing from the private sector, and we know that a number of support is still being announced by the days. You have individuals coming up to volunteer support and cooperate with the government, largely coming on the same page to support the government. We are thinking that all of that could help Nigeria recover in a relatively good time compared to other markets. So the impact of the current crisis is unprecedented, but then at the same time, for the first time in a long time, we are seeing a very good handshake within the fiscal side and the monetary side. We are seeing private institutions volunteering to help in the fight. And like Michael mentioned, even before the government announced shutdown in Lagos, Ogun, and Abuja, you have a number of private companies that have already activated remote working for their staff, and that is a bit commendable, right? And we are thinking that the AFDB is also moving in the right direction. The Committee of African Finance Ministers, they are moving in the right direction. We think the move to get that debt relief could be massive. Any support we can get to actually confront this challenge, to confront this medical-cum-economic crisis, should be commended as much as possible. I think we would be better with these measures. If you take these measures away, it will be way devastating for not just Nigeria, but then the African economy at large. Thank you.
Thank you, Philip. The next question is from Lolomari George. What is your assessment of the long and short-term impact of the CBN's decision to exclude banks and PFAs from the OMO? The second question is around the excess supply of crude oil right now. Is it a real threat in the coming weeks? Yes.
Okay, okay, Mike, I want to take it.
All right. So on the CBN's exclusion of domestic players in the OMO market and non-banks in general, I think our position is that that is the norm, right? These OMO instruments are meant to basically manage liquidity for in the banking system, and what they've turned to in the last few years has basically been easy money for a number of institutional players, which has also diverted them from their core business or from their core tasks. So in the long term, we think that this move is really what the system needs to get, to get back to the right track. But in the short term, we've obviously seen the liquidity impact play out in both the fixed income and the equity markets. That liquidity impact has tapered off somewhat. And I think by Q3, Q4, we might see a complete normalization. And basically, we might see these instruments being used more closely to what they are actually meant to be used for. Obviously, OMO instruments are still being patronized by foreign portfolio investors, which is not which is also not what they are meant to be used for. But at least this is a step in the right direction. And we believe that for the longer term, it makes the interest environment more reflective of the real fundamentals. And it basically realigns a lot of industries back to their core functions, which could also stimulate the real sector. So I think the second question was around the oil market, and do we see this supply glut lasting? So I think, as I mentioned in the presentation, the current surplus is around 20 million barrels per day. And this surplus is likely to widen in the coming months as lockdowns expand from city to city within continents. And also the OPEC cut, or the OPEC agreement, recently expired on April 1st. So we should expect a lot more supply from Saudi, from OPEC producers in general, from Russia, as they all basically intensify their push for market share in this oil price war. And so with more cities going on lockdowns, with greater supply push or with greater production push on the back of the recent end to the previous OPEC agreement, we expect things to get worse in terms of oil prices before they get better. We received a glimmer of good news today when President Trump suggested that Russia and Saudi were closer to an agreement. But given those two countries' aim of reducing the participation of shale players in the oil market and also capturing market share, we don't, our base case is that this will not happen at least for a few months. So in the near term, we see things being stable or worse in the near term.
Thank you, Michael. Ladies and gentlemen, we apologize, but won't be able to take all the questions that we have. We will be taking just one more question, but we'll try as much as possible to answer all your questions via email. So the final question is from John Neapold. So he said his question before was not about the level of repatriation. It was more about the expected response from the CBN. In 2016, the central bank basically stopped repatriating dollars for portfolio investors. So what is their likely response this time around? Since the lockdown, the CBN has not allocated dollars to foreigners for repatriation. Is that likely to continue?
Hello?
Yeah, Flip, go ahead. Hello?
Hello? So, like I noted previously, the CBN is accumulating a lot of demand at the moment. And of course, we know the distraction of the whole COVID-19 period. But the expectation is that after this pause or this period, say in the next 2-3 weeks, the CBN will move to actually clear the backlog, right? And they will meet legitimate demand as appropriate. And of course, the repatriation related demand will have to be, will also be met, because they cannot afford to irk foreign providers of capital last as in 2016 because of the delicate structure or the of our reserves at the moment. I did mention that FPIs into UMO currently account for about $12 billion. So they do not want to take any decision that will put them put the realities in a different light. So we are thinking that the CBN will move in to clear whatever backlog there is because of the current distractions, and normalcy will be at least restored in the near term. In the near term, at least they will hold their own, given that the demand for dollars, some legitimate demand for dollars, also declined basically. So they're likely going to meet those demands in the coming weeks once things settle a bit.
Thank you, Philip. Ladies and gentlemen, that was the last question. Thank you all for sparing your valuable time to join us on this call. Please feel free to reach out to us via email, that is is@cardinalstone.com, if you have further questions. Do stay safe and continue to take the necessary measures to protect yourself in these trying and uncertain times. On behalf of CardinalStone Securities Limited, this concludes the conference. Thank you for joining us, and do have a good day.